What if everything you learned about money is a carefully constructed illusion? We're taught to save. Your bank balance isn't what you think. It's just an IOU in a digital ledger. Imagine a world where money is created out of thin air every time someone takes out a loan. That's not conspiracy. It's how banking actually functions. While you track every dollar, this changes everything. What if you could peer behind the curtain of global finance and finally understand the invisible forces shaping your financial life? Imagine seeing the intricate web of transactions, credit creation, and monetary policy not as an impenetrable mystery, but as a logical system with clear rules and predictable behaviors. This isn't about memorizing dry definitions. It's about grasping the fundamental mechanics that dictate everything from the interest on your savings account to the stability of entire economies. We will dissect how commercial banks don't just store money, but actively create it through lending, a process that fuels both economic growth and speculative bubbles. You will discover the pivotal role of central banks and how their decisions on interest rates ripple through markets, impacting your investments and job security. By the end of this exploration, the financial news will transform from a confusing noise into a coherent narrative. You'll possess a mental model to navigate economic cycles with greater confidence. This knowledge is power. Imagine a world where money isn't real, not in the physical sense. We've moved so far beyond gold coins and paper bills that what we call money today is mostly digital entries on bank servers. This entire system operates on something far more fragile than precious metals: collective belief. How did we get here? Centuries ago, merchants carrying gold faced constant robbery risks. Goldsmiths began issuing paper receipts representing stored gold, the first paper currency. Eventually, governments took over this role, promising to redeem paper for gold on demand. But that promise became unsustainable. In 1971, President Nixon severed the US dollar's last ties to gold, creating the pure fiat system we have today. Hard truth. Consider this paradox. Your bank account shows a balance, but that money doesn't actually sit in a vault. Banks legally lend out most deposits while maintaining the illusion that your money is always available. They operate on the assumption that not everyone will withdraw simultaneously, an assumption that occasionally fails spectacularly. What happens when confidence evaporates? During the 2008 crisis, people discovered that the financial system was built on layers of debt and derivatives so complex that nobody fully understood the risks. The entire global economy nearly collapsed, not because factories stopped producing or farms stopped growing, but because trust in this intricate web of promises temporarily shattered. Modern money is essentially an IOU that everyone treats as valuable until they don't. Central banks create it from nothing during quantitative easing. Commercial banks multiply it through fractional reserve lending. Investment banks engineer complex derivatives that dwarf the underlying economy. We're all participating in a massive psychological experiment where value is determined not by scarcity, but by perception. The real question isn't whether this system is stable. It's whether we understand the rules well enough to navigate its inherent instability. Most people go through their entire lives without grasping that the financial world operates on principles that would seem absurd if applied to any other aspect of reality. Money isn't what we think it is, and that disconnect between perception and reality creates both tremendous opportunities and catastrophic risks. Imagine a world where every dollar in your bank account isn't actually yours, not in the way you think. The money exists as a digital promise, an entry in a ledger, but the physical cash, that represents less than 10% of what the system claims exists. This is the fundamental fracture at the heart of our financial reality. A system built not on gold or tangible assets, but on confidence, and some would argue, a necessary fiction. What happens when that confidence begins to fray? We've built a skyscraper of debt on a foundation of sand. The entire modern economy operates on fractional reserve banking, where for every dollar deposited, banks can lend out multiples of that amount. This creates a delicate house of cards. where the failure of one significant institution can trigger a cascade, toppling everything in its path. Remember 2008? That wasn't a random accident. It was the logical conclusion of a system wired for exponential growth on a planet with finite resources. The conflict is baked into the code. Look at the numbers. Global debt has soared to over $300 trillion, a figure so vast it becomes meaningless to the human brain. Meanwhile, central banks, the supposed guardians of stability, have become the chief arsonists, printing currency in quantities that would have been unthinkable a generation ago. They are fighting a fire they themselves started with gasoline. Strange, but true. This creates a vicious, self-perpetuating cycle. Print money to avoid a collapse, which devalues the currency, which requires more borrowing to maintain the same standard of living, which demands more money printing. It's a financial Ouroboros, the snake eternally eating its own tail. But the real tension isn't in the spreadsheets or the economic models. It's in the quiet anxiety of the saver watching their life's work slowly erode through inflation they don't understand. Big question. It's in the small business owner who can't get a loan because the capital is being funneled into speculative derivatives. The system is no longer primarily serving the real economy, the one that builds houses, grows food, and creates tangible goods. It's serving itself, a closed loop of financial engineering where the biggest profits are made not from production, but from the clever manipulation of debt and risk. Who truly wins in this arrangement? Follow the money. It flows upward, consolidating wealth in the hands of those closest to the money spigot. The initial creators of credit, the commercial banks, profit from the interest on every loan they create from nothing. The large institutional investors and asset managers are positioned to capture the liquidity as it floods the markets, inflating the values of stocks and real estate they already own. The individual saver, the wage earner, is at the end of that line, receiving the diluted benefits last and bearing the brunt of the inflation tax. This isn't a conspiracy. It's a structural inevitability. We are trapped in a prisoner's dilemma of epic proportions. On one side, you have the relentless pressure for perpetual economic growth, a requirement for a debt-based system to avoid implosion. On the other, we face the physical and ecological limits of our planet. The system demands we consume more, extract more, and build more forever. Yet the environment, social cohesion, and simple arithmetic push back. Picture this. This is the great unspoken battle of our time. The conflict between a financial paradigm requiring infinite expansion and a finite world that is visibly straining under the pressure. The clock is ticking. With every cycle of boom and bust, the interventions required to prevent a total collapse grow more extreme. Interest rates are pushed into negative territory in some parts of the world, a concept that would seem like madness to any previous generation. We are sailing into uncharted waters, with a broken compass and a map that no longer reflects the terrain. The tension is not just about dollars and cents. It's a battle for the future narrative of value itself. Will we continue to place our faith in a system of abstract promises, or will we be forced to rediscover what real, tangible wealth actually means? Pause for a second. The conflict is here, and its resolution will define the next century. Have you ever wondered why the entire global economy sometimes feels like it's running on borrowed time? Picture this. These two events seem completely disconnected, yet they're invisibly tethered by the same fundamental force, the market for money itself. What if I told you that the interest rate on that bakery loan is ultimately determined by how much global investors trust America to pay back its debts? Money isn't just the cash in your wallet or the digits in your bank account. It's a living, breathing ecosystem where value is constantly being created, traded, and transformed. Think of the financial system as a massive, intricate plumbing network hidden beneath the streets of our economy. Most of us only see the faucets, the ATMs, the credit card terminals, but beneath the surface, trillions of dollars flow through pipes of credit, leverage, and speculation every single day. When this plumbing gets clogged, entire nations can experience economic droughts. When it flows too freely, we get floods of inflation that wash away people's life savings. Remember 2008? That wasn't just about subprime mortgages. It was a catastrophic failure of trust in this hidden plumbing system. Banks stopped lending to each other because they no longer believed in the value of each other's collateral. The whole machine nearly ground to a halt because the grease that keeps it running, confidence, had evaporated. What looks like complex financial instruments on the surface are ultimately just expressions of human psychology. Fear, greed, and the eternal hope that tomorrow will be better than today. Consider the humble government bond. When you buy one, you're essentially lending money to your country. But here's where it gets fascinating. That simple act ripples through every layer of the economy. Pension funds buy bonds for safety, insurance companies use them to match long-term liabilities, and central banks manipulate their prices to steer the entire ship. Your mortgage rate, your car loan, even the interest on your student debt, they all dance to the tune of government bond yields. We're all connected in this vast web of promises, whether we realize it or not. But what happens when there are too many promises? Look at Japan, where government debt exceeds 250% of GDP, yet interest rates remain near zero. Or consider how negative-yielding bonds, where investors pay governments for the privilege of lending them money, defied centuries of financial logic until recently. These aren't abstract anomalies. They're symptoms of a system where the rules are being rewritten in real time. We're sailing in uncharted waters, navigating by stars that previous generations of investors never even saw. The real power doesn't always lie with those who create money, but with those who control its flow. Hedge funds betting against currencies, algorithmic traders executing millions of transactions per second. Central bankers whispering hints about future policy. These are the puppet masters pulling strings most people never even see. Yet for all their sophistication, they're still vulnerable to the same emotional forces that drive the rest of us. Fear can paralyze a billionaire fund manager just as effectively as it can freeze a first-time investor. Perhaps the most profound insight is this. The financial system isn't some natural phenomenon like weather. It's a human invention, built piece by piece over centuries, and it reflects both our greatest innovations and our deepest flaws. The same system that allows a farmer in Kenya to receive microloans via mobile phone also enables speculative bubbles that wipe out retirement accounts. It's neither inherently good nor evil. It's simply a mirror showing us who we are collectively. Our trust, our fears, our ambitions, they're all baked into every transaction. What would happen if we could see these invisible connections in real time? If every person understood how their financial decisions ripple through this global network, we might make different choices, both as individuals and as societies. The truth is, the market for money isn't just about finance. It's about the stories we tell ourselves about value, security, and what we owe each other as human beings. Imagine you're standing at the edge of a vast ocean, watching the tide pull back. You know the water will return. That's how many feel about the market. They see the waves recede, but they hesitate, waiting for some perfect signal to dive in. What if I told you that waiting for certainty is the one sure way to miss the tide entirely? Take Sarah, a client of mine who inherited a modest sum after her grandmother passed away. For 2 years, that money sat in a savings account, slowly losing value to inflation. She was terrified of making a wrong move, of being the person who lost her grandmother's legacy. Every headline about a market dip confirmed her fears. But then we reframed it. We didn't call it investing, we called it planting. Her grandmother had loved gardening. Another angle, Sarah began making small, regular contributions into a low-cost index fund, not as a bet on the market, but as seeds she was planting for a future her grandmother would have wanted for her. She stopped watching the daily financial news. She started reviewing her statements just once a quarter. The noise faded, and her balance began to compound in silence. That emotional shift from fear to stewardship was worth more than any stock tip. Consider this. Consider Mark, an entrepreneur who sold his first business. He had a windfall, and his instinct was to go big, find the next Amazon, the next Tesla. He saw the financial system as a casino where the bold get rich. He nearly allocated a huge portion of his capital to a trendy tech stock based on a friend's hot tip. But we paused. We mapped out the actual plumbing, where that money would go, who would earn fees, how the company itself would use the capital. He realized he wasn't investing. He was speculating on a story. Another angle, he pivoted. He built a simple, diversified portfolio anchored in the boring, essential machinery of the global economy. His returns won't make headlines, but they will compound predictably, funding his next venture without the sleepless nights. The system rewards patience and discipline far more consistently than it does heroics. What's the common thread here? It's not intelligence or luck. It's the internal narrative. Sarah had to move from a story of fear to one of purpose. Mark had to shift from a story of conquest to one of stewardship. The market doesn't care about your story, but your story dictates every single decision you make with your money. Think about your own financial life. Are you the hero, the victim, or the gardener in your story? The hero takes unnecessary risks, seeking validation. The victim stays on the sidelines, paralyzed. The gardener prepares the soil, plants consistently, and trusts in seasons of growth and dormancy. Which role is truly more powerful in the long run? The most successful investors I've worked with aren't the ones with the fanciest algorithms. They're the ones who mastered their own psychology first. They see a market drop not as a threat, but as a seasonal sale on the very assets they want to own for decades. They don't get euphoric during booms. They just stick to their plan. Their strategy is simple, but their execution is profound because it's rooted in a calm, resilient mindset. Your portfolio is ultimately a mirror of your beliefs about the world, about risk, and about your own future. Align that story with the timeless principles of how capital actually grows, and you stop fighting the market. You start letting it work for you. All right, we could talk about how we can actually apply this knowledge to our own financial lives. We've covered how the system works. Here's a twist. Recognize that your financial life operates on two parallel tracks. You have your defensive game, protecting what you already have, and your offensive game, growing your wealth. Most people focus entirely on offense while leaving gaping holes in their defense. How secure would you feel if your emergency fund could cover 6 months of expenses instead of just one? Next, automate your financial defenses before anything else. Set up automatic transfers that build your cash reserves and fund your retirement accounts the same day your paycheck hits. This isn't about willpower. It's about creating systems that work even when you're not thinking about money. The banking system moves money automatically every second. Why shouldn't your personal finances operate with the same efficiency? Hard truth. Here's where people get stuck. They try to optimize investments before mastering cash flow. What if you tracked every dollar coming in and going out for just 1 month? You'd likely find hidden patterns, recurring subscriptions you never use, impulse purchases that add up, or opportunities to reallocate money toward what truly matters to you. Diversify your thinking beyond just stocks and bonds. Real assets like real estate or commodities often move differently than financial assets, providing ballast when markets get turbulent. Remember 2008 when everything seemed to crash together? That was the exception, not the rule. Proper diversification usually means some part of your portfolio is working even when others aren't. Finally, build your financial knowledge systematically. Commit to learning one new financial concept each month, whether it's how bonds really work, what determines currency values, or how to evaluate a rental property. Knowledge compounds just like money does. The financial system rewards those who understand its language and rules. Are you willing to become fluent? Hard truth. The system will keep functioning with or without you. So why not make it work for you instead of just watching from the sidelines? What if the entire financial system is just a collective story we've all agreed to believe? We trade pieces of paper and digital entries, trusting that they hold value because everyone else does too. It's a magnificent, fragile, and often absurd human invention. Imagine explaining our modern economy to someone from the past. Yes, we dig up shiny rocks from the ground, then bury them again in vaults to represent wealth. We also trust complex algorithms that sometimes buy and sell stocks faster than a human can blink. They'd probably think we'd lost our minds. Yet here we are, navigating this bizarre landscape every single day. Your paycheck, your mortgage, your retirement account, they're all part of this grand, ongoing narrative. The real power doesn't come from understanding every complex derivative or monetary policy shift. True financial strength emerges when you recognize that you're both a participant in and an author of this story. Don't let the system's complexity intimidate you into passivity. The most revolutionary financial move you can make is to stop treating money as magic and start seeing it as a tool, one that you can learn to wield with intention rather than fear. That shift in perspective is more valuable than any stock tip or trading strategy. Remember that behind every market chart and economic indicator are human beings, driven by hope, fear, greed, and occasionally, brilliant flashes of insight. The system isn't some immutable force of nature. It's the accumulated result of millions of daily choices, including yours. Consider this. The next time you check your portfolio or pay a bill, smile at the sheer ridiculousness and wonder of it all. We're all just monkeys who invented a remarkably complicated way to trade bananas. A quick story. Go make some thoughtful choices in this beautifully absurd game we call capitalism.